Coming up today, the bears get wrecked. Have you been a victim of bear porn? A preview of CPI tomorrow, the latest from AAPL, 3 overlooked areas of the market, Bill Huang's going to prison, and the latest on the US presidential race. It's going to be a good one, guys. Let's go. Just look at this rally in the stock market. Bears getting absolutely crushed here again today. S&P 500 56.33 new all-time highs, and market color is turning green across the board. In fact, it's red in all the places that the bulls want. Bond yields, oil, energy, and the dollar index, with all indices and stock sectors still above their long-term 200-day moving averages. So for those of you who don't know, this is called the bull market. It's not a bear market when we're hitting new all-time highs. And so if you want to keep being made aware of all the opportunities out there, how to properly diversify a portfolio and survive and thrive through any market environment, then click the like button on this video. And that tells the algo to keep showing you my videos instead of constantly having your mind polluted with bear porn and being filled with fear and inevitably missing out. Because in my opinion, if you're not making money on a day like today, you're not doing it right. And that's something I want to quickly talk about on today's show, is all the bear porn out there. Headlines of imminent crashes, filling your mind with fear. And the fact is the content we do consume does affect us and does play into our decision making, especially headlines like Get Out Now. And this guy here, Harry Dent, pretty well presented. He's got a nice suit on. He's got all the qualifications. And late last year, like we hear almost every year, crash of our lifetime is coming in 2024. Of course that didn't materialize. Market's up already 15% year to date. And he's already coming out and prepping for next year. Stock market crash, then 2008 crisis, coming in 2025, he says now. So of course you'll eventually be right one year. Then he'll tell everybody, look, I told you, crash is coming. Can go around, do some interviews, sell some books or whatever. And the fact is that clickbaiting of fear and imminent crashes, or what's also known as bear porn, it just works. It grabs people's attention. However, what's it doing to your mindset? And at the end of the day, is it really making you money? Because I think it's more similar to a car crash. Everyone slows down to have a look. It's what the mainstream media does as well. Try and sell you fear, try and make you angry, try and bait you into identity warfare, all that bad stuff for their own benefit, just like content creators are doing all this stuff just for extra clicks and views. And even the best and smartest bears and hedge funds that short can often get wiped out. We saw that with Melvin Capital, who was backed by Citadel, one of the largest hedge funds in the world. Had to close down as they got caught in a short squeeze with GameStop. And even when the best short sellers in the world make money, they have a hard time at doing it. We saw that with Hindenburg Research, probably the most famous short seller there is in the market today. They targeted Adani Group, large Indian company, and their short report ended up wiping $153 billion off their market cap, but Hindenburg Research only made $4 million on the trade. In fact, the most successful bear and short seller of all time, Jim Chanos, famous for pointing out and profiting off Enron, he actually targeted my investment bank that I was working for back in 2007. He shorted the stock. I remember our CEO was scrambling to fight his media campaign, actually invited him to the headquarters, which he denied. He's in the business for decades, and in the last 10 years, he was more long short, and even being long short didn't work out for him. 2008, he was managing $6 billion. At last count, it was $200 million, also forcing him to close down his firm. But even in the light of all this hard evidence, most people are just not interested in hearing bullish, optimistic opportunities. Like the video I published early last year on January 13, saying AI is shaping up as the next bull market, when pretty much no one was talking about it. As I saw Microsoft was considering investing into ChatGPT, and the stars looked like they were lining up for a new AI bull. This was back when NVDA was trading at split adjusted $15 a share. It's up almost 1,000% since then. My video back then only got 725 views, basically nothing on YouTube. And the video I just did only a couple of months ago, highlighting a little known stock with huge potential, Up Fintech, Tiger Brokers, just got a little over 1,800 views, and the stock's up over 30%. Since I made that video, no one's just interested in that stuff. And just to be clear, I've done plenty of sensationalist headlines myself. And whenever I do, the videos get way more clicks and views. Like this one I did here. Insiders dump record amount of stock onto retail traders, which was factually true. And because it's a sensationalist headline, I got over 6,000 views. But to be clear, I've never come out and said you should be completely out of the market, as my long-term viewers know. All my personal and retirement accounts have always been long only. Any shorts I have taken have been tactical with small amounts. There was a point last year I was taking some more tactical shorts, but like I said, it's always been with small amounts, and I've always held core long positions across my accounts. I've only taken just a couple of tactical shorts this year, and I haven't shorted anything for a couple of months now. And so this is something I'm going to lean into and how I'm going to shape the Click Capital channel going forward. I'm going to focus more on being optimistic and searching the markets for opportunities and showing you guys what's working out there, where's the opportunities, like I've mostly done for a while now. And so I know by being bullish and optimistic and highlighting opportunities, I just won't be as popular online. I won't get as many clicks and views, but that's okay with me because I actually care about my audience and I'm just trying to do the right thing by you guys long term and share with you how I actually invest and how I see things. And just to be clear, I don't always get it right. No one gets it right all the time. I will let you know when I've got it wrong. However, I'm always invested in the market somewhere. And like I said, I'm really focused on diversification in order to decrease those inevitable drawdowns and volatilities. And like I said, I'll be sticking it out through the next bear market. I won't be freaking out and jumping completely out of the market and try to sidestep the whole thing. It's just basically impossible. So you won't ever see headlines from me. The market's about to crash. Get out now. Sell everything. Those content creators are just trying to get your clicks, trying to get your views for their benefit. And in my opinion, it's actually quite lame and pretty sad to see so many people get sucked into that. But anyway, that's how it is. I'm going to keep looking and sharing the opportunities out there that I see with you guys. And hopefully you can appreciate that. Because there is always a bull market somewhere. And that's not to say there's not going to be another recession or crash or bear market. Of course there will be. However, like I said, I'll never get completely out of the market. Instead, I seek to avoid big drawdowns and decrease portfolio volatility through the power of diversification across many different asset classes, coupled with trend following, not owning any downtrending assets. Because the fact is, if you're a bear, you're fighting probably one of the most powerful long-term trends that is known to exist, and that's the expansion of the stock market over time. $1,000 invested 144 years ago has turned into over $259 million. That's the long-term trend you're fighting as a bear. And it's not just perma bears. For those who think they can sidestep recessions, bear markets, crashes, you got worse odds than gambling. Because if you just miss the 10 best days of the S&P 500's performance over the last 20 years, your average yearly return got cut almost in half. And in fact, if you just miss the best 40 days of the market, your average yearly returns actually go negative. Again, that is a huge uphill battle to fight. It's why even the smartest, most well-resourced investors in the world cannot pull it off long term. And just looking at the best in the business, Warren Buffett, and of course, he's an exceptional investor, but just to illustrate a point, ever since he took over Berkshire in the mid-1960s, the stock price now is up over 2 million%. Do you really think he cares that his portfolio and stocks took a 50% dive in the bear market crash in 1973 and 74? You really think he's worried about a 30-40% dip when he's made over 2 million% in his career? He's the richest stock investor ever. And in fact, if he hadn't given away any shares, he'd be the richest man in the world because he's always bought stocks. He's accumulated them. He doesn't short them. The most you can make from being short is 100%. But he's bought stocks like Coca-Cola, split adjusted for 70 cents back in the 80s, not to mention all the dividends and that compounding power of reinvesting dividends. And so if you think about it, when you're long stocks, you could also think of that as being short cash, because you give up the opportunity to earn interest on that cash, and instead you're putting your money into little pieces of businesses. On the other hand, if you're short stocks, you're long cash. Quite literally, actually, because when you short a stock, you're selling it first, the proceeds of that sale go into your account, and depending on your broker, you'll get paid interest from that. But just like that long-term chart of the stock market and trying to go against that by shorting stocks, if you're short stocks, you're long cash, and this is the chart you're long. $1 depreciated by over 86% in the last 50 years. Again, that's a huge amount of headwind to fight by being a perma bear or staying massively short with a large percentage of your net wealth for any extended period of time. Like I said, there's nothing wrong with taking some tactical shorts, maybe a pair trade, or even buying some hedges, fixed calls, put options. Just like we buy insurance in our real life, to insure our house, to insure our car, to insure our health. It doesn't mean you should short the whole thing. Because the truth is, when you look at the richest people in the world, how they got there is by having an ownership mindset. It's by having an accumulation mindset. It's by swapping their dollars for assets, reinvesting the profits, reinvesting the dividends. That's how you build wealth over time, not by trying to sidestep the market with your entire portfolio. That's nuts. And just to be clear, this isn't something I've just started. Like I said, all my personal retirement accounts have always been long only. Just my short-term swing trading. I've done some shorts, pair trades. Like I said, there's nothing wrong with all that. The point I'm making is a lot of content creators out there are trying to clickbait you with fear and imminent crashes for their own benefit. That's polluting your mind. I can't imagine how many billions of dollars have been lost from people staying out of the market with their entire portfolios. And I know people will come at me and say, oh, Jared, you're just a perma bull, or wait for the rug pull. You'll see. And of course, there will be a correction. There will be a bear market. But do you think we should really be scared by a 20, 30, 40, even 50% pullback when we can make 500, 1,000, 2,000% in the long term? And we're going to get shaken out just because of a 30 or 40% drawdown. So yes, I'm happy to be called a perma bull, but I'd much rather be a perma bull than perma wrong. And so that's something I'm going to focus this channel on going forward, is presenting more of the opportunities, being more optimistic. There is a lot of great things happening out in the world there, new technologies, and of course US stock market is richly valued. Don't get me wrong, there are big macro risks out there. In fact, I'd even put the chances of a recession happening next year at about 50 to 60%. But the great thing about the American stock market is it offers exposures all around the world, different countries, different asset classes, commodities, bonds, and foreign equity ETFs that I've been highlighting recently on this channel. In particular, Brazil, looking at the CAPE ratio here of America, the 10-year PE, over 33 versus Brazil's 12. Now sure, America definitely deserves a premium. The question is how much? And so US stocks are likely to see subpar returns in the next 10 years. However, the great thing is that investors, we're not just limited to investing in mega cap tech US stocks. That's why for the last couple of weeks on this channel, I've been highlighting other uncorrelated assets like Brazilian shares as being potentially cheap, looking to have technically put in a bottom here. Dividend yield of 7.4%, and here we are now, quickly trading back above the 50-day VWAP. There's also great opportunities in other uncorrelated markets like silver, currently just below 52-week highs, and looking back in history, when the Fed starts its rate cutting cycle, that often coincides with the start of a bull market in silver. Looking back in the early 2000s into 2007, silver rose 400%, again off those lows in 2008, going into 2011. Quick sharp rip coming out of COVID, and here we are now, with Fed funds looking to have peaked out and most likely on the cusp of getting cut. We could also be on the cusp of another major silver bull market. What could also be a great opportunity? Junior gold miners, looking at the spread of them versus gold. Been in a 15-year long underperformance. However, it's showing signs of bottoming out, and we could be breaking above this long-term downtrend. And in fact, out of all the sectors I track, junior gold miners was the best performing one today. Again, approaching 52-week highs. And the small cap miner I just gave out to paid members this Sunday. The latest stock I just bought, that was up over 5% just today alone. And so my point is, there's always opportunities out there. Yes, US large cap growth stocks are richly valued, are likely to underperform going forward. However, I don't think that means we should stay completely out of the market. Like I said, through the power of diversification, we can invest in uncorrelated assets that are uptrending and can perform well, even when the US stock market inevitably pulls back like it will one year. And all those bears like Harry Dent will come out and say, I told you so. They'll eventually be proven right. But there's a reason why. The richest people in the world are bulls, they're not bears. They're optimistic. They're not pessimistic. They see the glass as being half full, not half empty. And even though it's very early days, the brand new trading account I started for my new stock pick service, it's already up over 5% in the first month. In fact, time weighted return is up over 7% already. And for those of you who don't know, I've started a new stock pick service with a brand new trading account. I'm going to buy $500 worth of a new stock every Monday, following my unique trend following strategy where I follow both the technicals and the fundamentals. We're holding positions on average for about 6 months. Winners can be held up for a year or two. All proceeds from stock sales I'll reinvest equally back into open positions at the start of every month. So I'm pyramiding winning positions. And so my goal is to take this brand new account into $1 million in under 10 years. And to do that, I'll need to invest about $415,000 over that 10 years, make about $585,000 in profit, and I'll need to achieve an average annual return a bit under 18% in order to hit my goal. And so for my paid members, I send out my weekly stock pick every Sunday morning, giving all the details the day before I buy the stock, explaining in simple plain English what the stock does and why I like them and all the numbers. You also see screenshots of all my trades inside the private members area. Everything is 100% transparent, including weekly updates on what the account balance is in US dollars, all performance stats, along with a monthly performance report of how the portfolio is going, along with some commentary. And so I designed this as an educational service to demonstrate in real time disciplined wealth building and giving insights to others to watch me grow this brand new account into $1 million in under 10 years. And I'm quite confident I'm going to hit my target. And so if you're interested in joining this journey and hopping along for the ride, then click the link below this video and take advantage of my special launch offer to save 40% before it expires in just a couple of days. And just to be clear, this is the only time I'm going to offer a 40% discount off this service. So instead of paying $770 one-time fee for lifetime access, once you hit the checkout, just use coupon code STOCK40. That'll knock over $300 off for you, and you'll only pay $462 one-time fee, no ongoing costs for the next 10 years. That works out to only be $46 a year, and I'm happy to stack my trading membership, transparency, results, and pricing against anything else out there, because I think you'll struggle to find this level of transparency from anybody else. Like I said, they'd rather sell you some bear porn or some vague alerts or trading ideas. So if you're interested in joining me on this journey and want to find out about all the exciting opportunities I'm investing in on the day before I invest them, along with receiving exit alerts, on the day before I sell, giving you all my reasons, everything clear out in the open in the private members area. Then visit my website, clickcapital.io, and jump on board before I close down this sale in just a few days. Okay, diving back in the daily market review, we got CPI monthly inflation report coming tomorrow. According to FundStrat's Tom Lee, it's going to be a big moment for the bulls. He expects a soft report to come in that will likely give the green light to the Fed to go ahead and cut rates, maybe 2 times this year, as he's expecting to see a continued drop in inflation. And again, I know this is one of the most hated guys on Wall Street. Fact is, he's been spot on right these last couple of years. And the fundamentals of this market are strong. And we're just getting into Q2 earnings season. Obviously, still very early days. We've only had 19 companies report so far at the S&P 500. However, they're already coming in well above trend. 84% of them beating on estimates. Analysts are expecting corporate profit margins to increase even further going out the rest of this year and next year, and that's been another big driver of this bull market. Not only corporate buybacks, but just the largest American companies are absolutely printing money. They dominate the global industry of technology, pretty important one of our lifetimes. We all use these apps around the world, and yes, that is accounted for in the stock prices, obviously. American stock market's been on an absolute tear since it bottomed in March 2009. However, that's also coincided with the emergence of these big dominant companies. Apple with their iPhones, Meta, Facebook, Alphabet, Google, Microsoft, Amazon, Tesla, NVDA, the list goes on. And so here's the comparison to the European stock market, ETF FEZ. It's been flat since 2007, really sad case. For some reason, there's just a lack of innovation in Europe. It's really suffocated their capital markets, in my opinion, due to overregulation, overtaxation, socialist policies, etc. And of course, this spread could converge somewhat. However, I don't think you should expect a massive convergence all the way back down for America and all the way back up for Europe, because like I said, the American stock market does deserve a premium for valuations, outperformance. They make so much more money. And for example, you could have done this same thing, say 100 years ago. You could look at the American stock market over a 10-15 year period and maybe compare that to, say, the stock market in the Middle East. And you might think, wow, there's a big gap between the Middle East stock market and American stock market. Back in 1920, 1940, whatever. However, it still would have paid to stay invested in the US stock market, because like Warren Buffett always says, those who bet against America often go bankrupt. And America's exceptionalism could continue for many more decades to come. And so just looking at mega cap tech stocks, the NASDAQ index, there are some similarities from the late 90s. However, there are some key differences. Valuations are not as crazy. The big tech companies now are actually making really good money compared to back then when they weren't. Also, that last couple of years, that price gain was absolutely ridiculous. And so markets can get really volatile in bear markets and bottoms, but they can also get really volatile at tops. As the market goes on racing higher, huge mainstream participation, stocks swing around a lot, and option dealers will start lifting their implied volatilities in anticipation of the eventual correction and crash. However, we're just not seeing that right now. Looking at realized volatility in the stock market, back in 99, 2000, that was 1.5%, 2%, even got up to 3.5%. Here we are now, just hanging around 0.5%. The stock market's not moving around much at all. There's the VIX index there, just below 13. And again, just looking at the data, which I always try and follow. We don't want to make data-driven decisions. Instead of emotional and news headlines-based decisions, just looking at historical data. Typically when the VIX is low, the stock market will put in good forward performances, and vice versa. When the VIX is high, market returns can be quite soft. And so option dealers are just pricing volatility super low. Even in the short term, looking out to inflation tomorrow, typically CPI can get markets moving. Option dealers have got the VIX one-day index just sitting at 13. They're not forecasting any major surprises to come in tomorrow, or any big movement in the stock market. And that's contrary to what you'll probably see out there today in all the video titles. I'm sure you'll see like CPI coming, look out, stuff like this. And who knows, CPI could very well come in hot. The market could pull back. However, again, I'm just following data. Option dealers aren't always right. However, most of the time they are. Another typical sign that the market's in a bubble and it's about to burst is margin debt. The amount of people borrowing to invest in stocks. We saw that in the late 90s. We saw that in 2007 especially. However, we're just not seeing it right now. There's not much margin debt. In fact, margin debt as a percentage of the stock market capitalization is down near the low end of the range. Could be a lot more ammo out there. And who knows, S&P 500 could go to 10,000. But the fact is right now, and I'm seeing this all across my social media feeds, no doubt I'll have a few people come at me today with this, the amount of people planning to increase their equity exposure is getting down to lows as well. Saw back in late 21, near the last market top, 80% of people planning to increase their equity exposure. But like I've observed in my 20 years of trading and investing, most people are wrong most of the time. Unfortunately, that's true. We can especially see that in markets. And so I'd say right now the pain trade is higher. And there's an old saying in the market, the maximum amount of profit is possible through the maximum amount of people being wrong. And just to be clear, apart from some ETFs, I don't really own any large mega cap stocks directly. My attention of late has been more on small caps and the historic underperformance this year versus S&P 500. We haven't seen anything like this since 1998. The gap between small cap and large cap performance year to date, and so I'm positioning my portfolio more towards small caps, value stocks, commodity stocks, and foreign stocks that are listed on the New York Stock Exchange. I believe they have a better chance of outperforming large cap growth going forward. And that doesn't mean I'm avoiding tech altogether. In fact, in the new stock picks portfolio, I've got a small cap tech stock, growing like crazy, but only has a price to earnings PE ratio of 12. And so I'll always have some tech, consumer brand, industrial names in there. Typically over the long term, they do outperform. I just don't like large cap tech right here. Just moving on, we had Jay Powell wrap up his 2-day testimony in front of Congress. Market seems to have interpreted it. He's getting a little dovish. I think he's kind of in between a rock and a hard place. I think he may be worried that Trump's going to win the election. He's still the possibility he may want to see how the election plays out before he makes his next move. Otherwise, I still think there's a good chance he could cut in September. The data is there to support it. Many measures of inflation are pulling back. The jobs market is softening somewhat. And just looking at the price action and the government bond 2-year yield, which often leads the Fed, looks to have lost support and it's holding below the support here, potentially making a new low and a downtrend, 4.62%. And according to JP Morgan, there's 3 overlooked areas of the stock market that have some potential upside outside of AI. We're going to see a broadening of earnings across the market going into the rest of the year and next year. They say some depressed areas like personal electronics, communications, and enterprise may soon bounce back. Rail and parcel, as automation is also expected to increase efficiency, and home improvement. A lot of Americans have put on pause their home renovations, held back by high interest rates. So if interest rates come back, a lot of consumers may take out a loan to do some renovations. As the average US home age is increasing, and there's significant maintenance expenditure expected to come on board. Another thing I do on this channel for you guys is let you know what the strongest and weakest sectors and markets are out there. This definitely plays into my thinking a lot. Always start with the macro top down. As a trend follower, you want to be invested in the strongest areas of the market. And so just looking at key sectors and their percentage from the 52-week high, out in front, consumer discretionary, obviously large cap growth and tech, semiconductors, computer hardware, capital markets, aerospace and defense, financials, consumer staples, healthcare and telecom, all doing really well at the moment. What's not doing well? Energy still a little soft, home builders, pharmaceuticals, internet, transport and healthcare equipment. And there's just so much cash out there, it always needs to find a home. And in fact, what was one of the biggest risks in the market the last couple of years, commercial real estate. The markets and system have just swallowed up that risk so well, quite remarkable. The Fed got in there and backstopped them before it even blew up, and Wall Street's already lining up to take advantage of that. They've got over $250 billion earmarked for distressed commercial real estate, and they're already revamping a lot of these buildings into residential, as the residential market's still holding up really well. And some of the most popular hedge funds are having a good year so far. We've got Citadel Tactical up 13.7%, Third Point 11.6%, Viking 8.2%. However, inflation hasn't completely gone away, especially if real assets keep ripping. We've still got freight and shipping rising. That could affect retailers, affect imports, stuff like that. And for sure, inflation's still a big risk. However, you can turn that risk into opportunity by positioning some of your portfolio into commodity. And we've got oil seeming to find its footing here today. So we've got crude supplies come in down for a second straight week, which is suggesting increase in demand, which is bullish. Current administration has been doing their best to keep the price of oil down. However, the market's been quite defiant and resilient. There's crude oil today, putting in a hammer candle formation, holding above $82 a barrel. There's gold continuing its months-long consolidation, but I'd still say holding a bullish formation here. One of the best performing global assets year to date, silver, still holding a bullish formation as well, with agricultural commodities being a little bit soft of late, but uranium having a really good bounce back today on strong volume. It's another commodity I am very bullish on long term. Moving on, infamous hedge fund manager Bill Hwang of Archeos Capital just found guilty financial fraud, duping banks and prime brokers, making huge leverage bets in the stock market. He had it all, billions of dollars. Greed got the better of him, playing games in the market, taking on way more leverage than all the banks knew he had altogether. And so now he could be potentially spending the rest of his life locked up in a cell. Moving on, the US presidential race. More and more people coming out calling for Biden to step down. Even people on his side of the fence, like George Clooney, a bunch of other Hollywood elitists. Threw him a big fundraiser just a month ago. Now George Clooney's come out, said he made a mistake, said he wasn't even the Joe Biden of 2020. He was all the same man we witnessed at the debate. So you know things are bad for Biden when even Hollywood elitists are coming out and speaking against him. And we've even got Nancy Pelosi, longtime Democrat, saying she's encouraging him to make a decision because time is running short, which is pretty much an indication she's not backing him and she has strong influence. And it's been reported that Ozzy Osbourne has been in talk with MSNBC and will be interpreting for Joe Biden at the upcoming presidential debate. That's just a joke, guys. It's fake news, but it's actually hard to know these days what's actually parody and what's really real. What is real is the record amount of unlawful border crossings. That was kicked off at the start of 2021 when Biden took office and changed all the rules. And this could actually be part of the reason why the US economy has been holding up a lot better than the rest of the world the last couple of years. Most likely contributed to a lot of inflation as well. However, now the administration is just looking to fix things as they go into the election. But I'd say it's too little too late, as most Americans have caught on to this. Trump's already lining up Kamala Harris to be his opponent, switching his focus from sleepy crooked Joe Biden to laughing Kamala. And it appears betting markets have flip-flopped again, now putting Harris back in the lead after those latest remarks from George Clooney and Pelosi. And so I'd agree with these odds as well. I think she is a front runner, and just how mind-blowing it'd be if Biden stayed in and he somehow won again. And we still can't rule out the possibility of Newsom entering the race as well, in which I'd think he'd have a much better chance than Biden, as the mainstream media could throw him a big party and give him a honeymoon period that could carry through to the election. However, a lot of people view Newsom as America's version of Justin Trudeau. There's a look at your economic calendar today. Didn't get anything really major out, just crude and gas. Supplies pulling back. Tomorrow's the big one, inflation rate. Month over month expected to grow 0.1%. Year over year 3.1%. Going into Friday, PPI, Consumer Sentiment Survey. Fear and Greed Index hopping back into the greed zone for the first time in a long time, being in neutral and fear for a long time. Still don't have the best market breadth out there, but other measures of fear and greed are hitting extremes. And it's true, in the short term, we are a little technically overbought here. Market is a bit stretched. However, like I always say, really strong short-term price action bodes well for the medium term, as markets don't typically crash when they're making all-time highs. Typically, they roll over first underneath the 50-day VWAP, then it kind of turns into a waterfall. But like I've been saying, you shouldn't position your whole wealth portfolio in life just waiting for that once-in-a-decade event that's pretty much over in a couple of months, and it often presents as a great opportunity to add more funds back into the market, actually. Looking at Fed Fund futures going into CPI tomorrow, 73.3% chance we're going to see a cut in September. We'll be paying close attention to these numbers tomorrow, see how interest rate markets are pricing the probability of a cut. And I'd say if CPI even comes in line or a little soft, we may start seeing increased probabilities of a cut come later this month, if not an almost certainty in September. I'll also be paying attention to the price action in high-yield corporate bonds. Kind of shaping up a bit here, holding in this really long consolidation all year. And one could argue this is a bit of a bullish formation, what's been happening all year in high-yield bonds. This could turn out to be a base for a new breakout, and this is a key measure of risk sentiment in the market. These are bonds which represent debt to more risky companies that don't have the strongest balance sheets, typically smaller companies. Investors demand a higher yield to compensate for that risk. And so if they break out to new yearly highs, again, that's bullish for risk sentiment and markets. That's not a bearish sign. And other sectors too, like financials, looking a bit bullish on the chart, and utilities starting to creep back as well. Normally a defensive sector, I think they're a massive beneficiary of the knock-on effects of the AI boom, and this could continue for utilities for a few more years yet. With one of my favorite utility companies in the renewable energy space, long-term viewers know I'm long-term bullish clean energy. NextEra Energy, coming out of Florida, having a really good year so far, looking to creep back above the 50-day VWAP. All right, guys, that's all I've got for you today. Thanks very much for tuning in. And for anybody else who's thinking about joining me on my $1 million journey with my new weekly stock pick service, there's only a few days left to save 40% and just pay the one-time fee of $462 for lifetime access. So if you're interested in hopping on board, click the link below this video and head on over to my website, clickcapital.io, and use coupon code STOCK40 before this expires in a few days. Other than that, I'll be back again tomorrow night to break down CPI inflation and see what sort of price action we get from that along with everything else. Thanks very much, and I'll see you again then. Cheers.